Welcome everyone to the Jacksonville Q2 quarterly market, Q3 quarterly market up. We finished Q2. This is the beginning of Q3.
We're out looking into the future into Q3.
We're looking into the future of Q3 Jacksonville market forecast then. Welcome, everyone. I'm your host, Pablo Gonzalez. With me, as always, a man that I actually like to call GC because he's got the genius concepts, knows how to generate cash flows, is a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you.
And GC, this is also the show that you really kind of like think about for a while. You prepare for a long time as you were getting ready to think about the forecast coming into Q3, looking back at Q2, Q1, things that have happened. Anything stand out to you as you were preparing for this?
You know, I had a lot of fun putting the slides together here and the thought process together here. And I think the reason that I had the most fun, a couple of things. Number one, my thesis about why I love rental properties is because they're boring. And they just work. And if you cut out all the noise, it just works. So what I was thinking and seeing as I was preparing for this, you know what? It's just working. If we just cut out the noise, it's just working. Mm-hmm. But I think the reason that I was a little bit more excited this time is because it doesn't take maybe just believing what I'm saying or understanding the theory here. Now you're actually seeing it play out in the numbers here. So I'm excited to share those numbers. I think the call today is probably going to be a little bit more number heavy than we do routinely on these quarterly calls. And part of that is because we're seeing this playbook play out. The same playbook that JWB has been investing in for 20 years and that many of you as clients have been investing in for 5 years, 10 years, 15 years. That same playbook is playing out. So excited to share it with all of you today.
That being said, you see, to your point, right? Like this idea of new to the market updates this quarter. I think emphasis on the numbers. We've heard a lot from people that what they come for is these numbers. So sometimes we like spend a lot of time on headlines and these different things. I know that this is being listened to by people beyond our audience, people that want to get to know Jacksonville. So we're going to go right into the numbers for you. We're going to dive deep into that. And then we've got a couple of updates on just like overall topics.
Things you need to know about.
Things you need to know about. So let's dive right into it right now. Let me share the screen. And there we go. Okay, cool. I'm still doing that thing, right? So Q3 2026 real estate market outlook. Something to know is that this is for informational purposes only. We're not financial advisors. Do your own due diligence. Anything else you want to say here, GC?
No, I think you nailed it.
Okay, nailed it. That being said, the JWB team is here for you to make sense of this data that we are sharing today. You can feel free to call JWB right now at 904-677-6777. You can text right now and someone will get back to you after the show, 904-293-0341. Or if you want to just like look at your calendar, look at their calendar, pick a time to meet, go to chatwithjwb.com. Easiest thing to just put it on there. Let's start with the actual snapshot. GC, I see a big bolded normalization thing here. I think you describe it as back to boring, which is your favorite thing. Tell me more about this. Normalization.
And normalization is a concept that we introduced years ago. 2-3 years ago. And I felt it was really important at that time to share with everybody that what would be happening in future years is following a pattern. And this normalization was going to happen. And I wanted to make sure that people were not fearful for the many headlines that were calling for the demise of real estate or single family rental properties or whatnot. It's just normalization. There is a cycle and a pattern that happens with real estate. And the cycle has been playing out. Normalization is what you're continuing to see here. I'm going to show you in a graph what I mean by that in a second. But ultimately, that's what we're seeing here in Jacksonville, and you're seeing that in many places in the U.S. So all of this noise that has been calling for these drastic actions just has not been playing out, just as it didn't play out 3 years ago or 5 years ago or many, many years ago as people have been calling for these drastic actions. This is just a boring asset class that just works and works and works. And I love boring. Boring works because boring can help prepare for your retirement or your kids or grandkids going to college or preparing to donate to your favorite charity. That's why I love boring so much. And you're going to see that in these numbers.
Got it. So we're going to save some time for questions at the end. If you have anything, put it in the Q&A, because if you can see the chat, it is zooming with a bunch of people talking to each other, right? So use the Q&A button, pop it in. GC, let's start with the median square foot home price in Jacksonville at $369,000. Home price appreciation year over year at 3.9%. Home price appreciation year over year, 6 months trailing 1.1%. Median days on market at 34 months of inventory, the statistic that we made famous here on the show, at 4. Foreclosure rate at 0.9%. The median home price, GC, 369. It feels like it's been there, it's been right around there pretty consistently. And yet it also feels like a really high number than what we used to report.
Well, that's true. It's because home prices have gone up, and they have continued to go up even in the face of higher interest rates than we all would like. And so what's really noteworthy here is this is 3.9% home price appreciation year over year. That means this is from May data of 2025 to May data of 2026. And so if you look at the home price in last year to this year, the home prices in Jacksonville are up about 4%. That's really surprising, I would imagine, for many people on this call, because all we have read for months and months and months and months is that, and years now, is that home values are declining and home values are going to decline and whatnot. And this isn't the only month where home prices have been up. The last quarterly call, I shared that home prices had been up year over year at that point too. So you're seeing this trend of actual home price appreciation happen. Now, the 3.9% number is interesting to look at, but the number that I look at the most, because it smooths out and removes the opportunity for like one good month of home price appreciation, is that 6-month trailing number. And this is a little bit, you're going to have to follow me here just for a second. What you want to do is you want to look at the year over year appreciation rates for the last 6 months and take an average of them. And what that does is it eliminates, one good month or one bad month from an appreciation perspective. So we look at year over year appreciation, but we average for the last 6 months. And this is an industry standard way to look at this and really just make sure that the trend is something that is substantial rather than a one-hit wonder, let's say. And so if you look over the last 6 months trailing for home price appreciation, we are positive again. So home prices actually have been up a little bit over 1% here in the Jacksonville market. And that's why I say it's not just this month where we're up 4%. It's the average of the last 6 months. You're really starting to see this trend develop, which is really good for you guys to know, because you're reading articles about things that are saying that home prices are declining or are about to fall off a cliff. The data just has never really supported that, and it's really not supporting that now.
GC, remind me, correct me if I'm wrong, but when we talk about a lot on the show, this idea that we think about home price appreciation not in a year over year. We like to look at it for 30 years, and then you can really count on that. And if I remember correctly, over 30 years, the home price appreciation is 4.9%, right? So it's still raising. It's still going up in a year over year basis, but it is lower than the historical 30-year average right now.
Yeah, and that's not unique.
Okay.
From year to year, you're going to be either above the historical average or below the historical average. That historical average, 4.8%, if we're being specific about it. And that actually goes back longer than 30 years. It goes back over 40 years. Okay. That's the last rate. The data started to get reliable about 1982. Okay. And so you go back as far as you possibly can, and you average out what the annual home price appreciation rates in your market are, and that gives you a very good indicator of what your home price appreciation will be over the next market cycle for you. So think about holding an asset for the next 10 years, 15 years, 20 years. If you know what the average appreciation rate has been over the last 40 years for Jacksonville, it's like you have the answers to the test. You're going to know within a small range what your average home price appreciation will be on your asset for the next market cycle. And so that's really important information to know. Yeah. Now, on an annual basis, we're going to look at what home prices do because that's important. You need to know that, but that's not going to wag the tail that much. Okay. Or the tail's not going to wag the dog that much when it comes to 1 year of home price appreciation. When it comes to 40 years of historical home price appreciation, which is between 4.5% and 5%.
And again, audience here is buy and hold rental property investors. So we talk about this idea of not making a 5-year and less decision here. You're making a 10 plus year decision here. And when you look at it in 10 to 20 years, we're going to expect to look back and see this blip 3.9% appreciation year over year, but overall smooth out to about 4.8% appreciation over that market cycle, right?
There you go.
Got it. All right. So then let's talk about, let's go a little deeper into this year over year, 6 months trailing 1.1%. Does that mean that in 6 months it's gone up 1.1%? So the rest of the year would have gone up 2.8%? Or is it like just go a little bit more in detail of kind of like that delta between the 3.9 year over year versus the year over year 6 month trailing?
Yes, absolutely. So this month,
yeah,
compared to 1 year ago,
okay,
3.9% growth. So May of 2025 to May of 2026.
If I bought May of 2025, chances are that my home has gone up 3.9% since then.
Yeah, the macro of all properties in Jacksonville have gone
the
up.
average.
The median, which is an average, right? So now, how that relates to the 6 month trailing, that's 1/6 of the 6 month trailing.
Okay.
So when we're talking about 6 month trailing, it's saying, well, for May to May, it went up 3.9%. That's one of the 6 months that is averaging out to get the 1.1% of 6 month trailing home price appreciation. Does that make sense? So it's not what you were thinking originally. It's not like you can subtract those and.
Yeah. Let's just talk it out then. So May to May was 3.9%. That means that April to April, the other 5 months before that would have been lower than 3.9% if the average is 1.1%.
Yeah, exactly.
So essentially, this is where we're at right now. One could say that if I'm looking at it graphically, then there's going to be an average of 1.1%, but this, since we're at 3.9%, it feels like a tilt up within that mean. So
that is true.
So maybe this looks like acceleration, at least in the short term.
Exactly.
Okay. Interesting. All right. Cool. Good to look at that. Median days on market. Again, this is sales data, right? So this is how long a house gets. If I list my home, my home gets sold within 34 days, kind of thing. A little bit over a month. That seems super normal. A month is sell a house.
Very normal and low compared to historical standards. Yes. 34 is lower. It's lower than it was the previous month and the previous month before that. And we're actually going to compare it here to other times. But again, really fighting this narrative, it is not hard to sell your house in Jacksonville today. It is not a market where you cannot sell a house or that you have to expect a price decline to sell your house. It's a normal market. Normalization is what we're experiencing for those who can cut through the noise here.
Got it. Months of inventory for those of you that have not been watching the show for the last 5 years. Explain that statistic real quick, GC.
Yeah, absolutely. We want to have a leading indicator for where prices are likely to go in the near term, say over the next 12 months or so. And so what we do is we look at the number of homes that are on the market and the number of homes sold in the previous month. And if you just think about it like you're a business owner and you've got a lot of inventory, and you want to see if you want to raise prices or if you want to drop prices, well, you'd look at the amount of inventory that you have and you'd see how much sold last month. And you'd probably say, well, you know what? That's how I'm going to gauge whether or not I'm going to raise my price or lower my price. And in real estate, you can do the same thing. It's called months of inventory. And really, you look to see how many months would it take to exhaust the current inventory on the market. And what history shows us is a number between 4 to 6 months of inventory is below the historical average for months of inventory. 6 to 7 is average for historical months of inventory. And average would lead to average home price appreciation, which over the last 40 plus years,
4.8%.
There we go. Yeah. So that's 4.8%. And then if you get above 7, and the farther you get above 7, you could get to a place where you would see lower than normal home price appreciation. Lower than normal home price appreciation does not mean price decline. You'd have to get to really, really high months of inventory to see price declines. So that's really what months of inventory is. It's a measurement that we introduced really when we started to do the show 5, 6 years ago.
Right on COVID time.
Yeah, and that's why it substantiated our viewpoint that we didn't see prices going down, even though the rest of the world did. It's because we had low months of inventory. Well, guys, guess what? We still have low months of inventory. We have been consistently below 6 months of inventory almost every single month for the last 5 years, and we continue to be low in terms of months of inventory. So that just means that we don't have enough inventory in the market to satisfy the demand for an equilibrium market, which is leading to things like low days on market and higher home price appreciation, which is what you're seeing. All of these things relate, and that's why if you cut the noise, that's why the market is playing out the way it is.
So each of these statistics, in a vacuum, you can give it an attribute, right? And then you paint the picture with all the statistics. Months of inventory at 4 means it's lower than the average, like a historical average, which means it's a buoyant force as far as like in a vacuum for home price appreciation. Then we have Jack's foreclosure rate, 0.9%. That seems astronomically low.
It is. A normal market has about 10% of all properties as foreclosures. So 10% is the norm. We are less than 1% of all properties in Jacksonville that are foreclosures. And if you really wanted to construct a market that is going to have significant price declines, you really got to have a high foreclosure rate. Right now, there's over $30 trillion of equity across the entire country in homes. So the idea that there is this foreclosure crisis or this foreclosure wave is coming is not real. I've been calling that out for years and years and years that it wasn't going to happen. It hasn't happened. It will not happen anytime in the near future. And that's what you're seeing here with foreclosure rate in Jacksonville, less than 1%. It's incredibly low.
Got it. So if you were to paint the picture of these, median square foot price is a number that I would say probably 5-10 years ago, we'd probably be pretty impressed by right now.
Right.
Year over year, home price appreciation at 3.9%, with year over year 6-month trailing at 1.1%, means that home price appreciation seems to be increasing based on what we talked about. Median days of market at 34 is historically low, which means it's a buoyant force. Months of inventory is at 4.0 is low, means buoyant force. Jack's foreclosure rate at 0.9%, super low. Sales data seems to be pointing towards a upward trend in the home price appreciation market in Jacksonville.
So yes, sales data, everything I'm sharing with you. The one thing that may not be high and is probably down this year compared to previous years is the number of sales. And so just be very aware when you're reading articles and they're talking about the number of sales going down. You can have a market where the number of sales go down year over year, but home prices still go up. And I think the talking heads have a hard time of separating that. You can't have both of those things to be equally true. What many articles are written about is the number of sales is down this year versus last year, and they assume that the market is declining. That's not the case. So home prices are actually going up. The fact that we look at the last 6 months on average and we have over a 1% increase means that you got half of the data points of an entire year here. And so more likely than not that you'll see home price appreciation will get to the end of 2026 overall. So good leading indicator there.
Sounds good. So this sales data, this is home price appreciation. That is a big part of the return of why we invest in rental properties, right? Like we talk about how 5 profit centers, home price appreciation is often 60 to 80% of the overall returns that you end up getting. But of course, we also talk about cash flow when it comes to our home price appreciation, and that comes from rent data. So our rent right now in Jacksonville, median square foot rent price.
It's single family.
Single family. Yeah. Just on automatic over here. Median single family rent price. This is the JWB portfolio, right? Like this is now not Jacksonville, but JWB, which is representative of the workforce housing in Jacksonville, because you guys have 6,000 properties.
Well, we do. We now manage over 7,000 properties, which is pretty cool. So to get rent data, you really got to find a few different sources and put it all together. There's not one source that's going to give you all the information that you really want to analyze the market. So some of the data is Jacksonville based that we get from our consultants that we pay a pretty penny to be able to get that information. So when we're talking about the Jacksonville median single family rent price, that's coming from macro data. Same thing with the rent price appreciation. When you start to see JWB in front there, that's all micro data that we pull from our database, which now, we do manage over 7,000 properties here, and about 5,600 of them are here right in Northeast Florida.
All right. Significant database here in Northeast Florida. So kind of like what people don't get anywhere else.
Right.
Just
Very
throwing
hard.
that out there. Just throwing it out there. If you're on the show, this is why you come, right? So median single family price, $1,810. Single family rent price appreciation, down 0.4%. So relatively flat, a little bit down. Average rent price for JWB, $1,536. That's representative of the workforce housing demographic that you serve. Single family occupancy rate, 98.1%. JWB collection rate, 98.4%. JWB average turn cost to an owner, $1,204. Average property turn days, 10 days. Early termination / eviction rate, 0.4%. Renewal rate at 76%, and an average lease of 54 months. It's about 4.5 years. Do you see where do you want to start with these numbers? Anything you want to call out here?
I think when we look at the micro data, the JWB data, this is world-class performance for a property management team. Extremely proud of everybody on our team that works so hard to make these numbers work. At the end of the day, if you're buying rental properties, it all comes down to wonderful management of the asset, because that's what turns these fancy spreadsheets into real dollars in your bank account. And that's what creates a great experience for you. So really proud to see over 98% occupancy, over 98% rent collection. Property turn costs are significantly down. The days that it takes to take a home from during a property turn of only 10 days is something that we continue to shine with and get better and better year over year. So, and we haven't even talked about some of the things that ultimately separate, I think, a great rental experience from maybe an average one, just limiting turnover. So that comes down to 76% lease renewal. And an average duration of resident stay of 54 months. We just know at rental property owners, I'm a rental property owner, you're a rental property owner, you're probably a rental property owner, or you're thinking about it. The biggest pain point for you comes down to property turn, maintenance costs, vacancy costs. You have additional fees that you pay, and it all happens. You get punched with a property turn. And so we have constructed our property management to defer that as long as possible, and we invest in the relationship with the resident, and that's why residents choose to renew at such a high rate and stay for such a long time. And the benefit goes to the owner and your returns on investment over the long haul.
As now having been a rental property investor close to 5 years here, I can definitely say I'm having the most fun when my properties are rented, right? So like the thing I care the most about is this 76% renewal and 4.5 years occupancy, which has been like my experience. Raj Bantu, right along Raj, says renewal rate of 76% is amazing. Average duration of residency of 54 months, very good. I agree, Raj. So this idea of like most of the time my stuff is occupied, things are just cruising along, maybe minor maintenance things here and there, but I'm not having months without income is big. Let's talk about the average turn on property days for 10 days. I think when I first read that, I think, oh my gosh, like a resident moves out and I have somebody in 10 days. That's not what that means, right? Like this is essentially saying from when a resident moves out to it is rent ready for somebody to like look at it. And if they want to move in tomorrow, they could. That's 10 days. And that's essentially kind of like a minor renovation / glow up of the property that's needed to take it from like one family living there to another family living there, from the moment they move out to getting owner approvals, to getting budget approvals, to getting contractors in, to get it done, to like inspecting it and be like ready to go. That's 10 days, right? GC?
Exactly right. Yeah.
Okay.
And that's more than $1,200 worth of work. So when we talk about the property turn cost to owner, that would be the total amount of the work minus the security deposit, which is forfeited back to the owner. So the net cost to the owner is $1,200. So your total cost of work for those average of 10-day jobs is probably $2,500 to $3,000 worth of work, which is typically coordinating a number of trades. So to be able to knock that out,
carpet, whatever
it is, right? To get that all done in a week and a half is something that we're really proud of.
Oh, cool. Average turn cost of $1,204. So basically you're saying that that's like, there's a security deposit that's somewhere around $2,000.
The average rent for JWB is $1,536 here. So that is the average security deposit that is held on your behalf as an
Okay.
owner. And when the resident moves out, we of course do an inspection and we determine what damages are caused by the resident. We follow all the processes that we need to, and ultimately that security deposit is forfeited back to the owner. And so that decreases the net cost to the owner, and that results in about $1,200 net cost to you as an owner.
Okay, awesome. And I was just gonna say the collection rate, like I'm talking about kind of like having a property unoccupied is the most painful moment. So we're minimizing that piece. But that only works if you're actually also getting rent when it's collected. Right. So 98.4% collection rate. Man, that seems really, really high. That is I've gone through very few months in my experience as a JWB investor where rent isn't coming in. It was maybe during COVID, like stuff like that. So that seems to be like a super, super high number where almost everybody is essentially getting their pays on time.
It's something we're really proud of. In a previous quarterly outlook, I totaled up the number of months consecutive that we've collected over 98%. I can't remember what it was. It was over 40 or 50 months consecutively. And I think there's only 1 month in the last 7 or 8 years that we hadn't reached 98%. And oh yeah, during those 7 or 8 years, it was COVID time as well. So incredible job by our property management team. At the end of the day, you know what? We have to be excellent at property management if you're going to be happy with the investments that you have and if you're going to come back and buy more.
Yeah. An occupancy rate of 98.1% being different than rent collection rate. I assume that occupancy rate means homes that have a family in it based on the entire portfolio, right? Like homes that are occupied. Rent collection is within those occupied homes, 98.4% of rent is rolling in on time.
Exactly.
And then let's talk about this average rent price versus median square foot rent price. Does that mean that JWB is charging under market rent?
Well, so the median single family rent price is taking all single family homes in Jacksonville.
Yeah.
And so we specifically focus on workforce housing, and workforce housing has lower rent rates than the average or median household in Jacksonville. So that's why you're going to see our rent prices are below the median. What you'll also see is the homes that we sell are priced below the median as well. So if we remember from the previous slide, the median home price in Jacksonville is $369,000. Well, the average turnkey property that we sell is priced at about $235,000.
Yeah.
So you're going to see lower on the price, and then you'll also see lower on the rent, but that rent to price ratio is actually a lot better.
It sounds like it checks out, right? If it's like 330 is the average price, 230 is the average JWB price. That's a much bigger swing than 1800, 1500, right?
Yeah, exactly.
Okay, cool. So this is emblematic of workforce housing, right? Like this is catering to that 70 to 120% of median income. These are working class neighborhoods, and that's what rent is at for the JWB rent price.
Exactly.
Awesome. Let's talk about the negative number here, GC. 0.4% rent appreciation. Tell me about that. Negative.
Yeah. So, I mean, rents have largely been flat. I think the last time that we did this call, I think it was 0.1% positive. And we just talked about, hey, listen, in the environment that we're in right now with cost across the board rising and affordability being an issue, it's limiting the growth of single family rents, as well as the impact of the flood of inventory on the apartment side over the last few years. And so we've just expected flat, rents to be sort of flat, maybe slightly positive, and they've been kind of just oscillating between there. So I'm sure the next time that we do this report in 3 months from now, it'll be somewhere between 0.4% negative and 0.4% positive. But ultimately, rents are about flat right now.
That tells me that right now, if I have a turn coming up, renewing at the same rate is a win. Anything higher than that is like a super bonus. But I'm expecting essentially kind of like the same rent going forward. In this renewal period.
Yes and no. I would say each situation is different, and here's why. And you need to talk to your portfolio manager for your situation. JWB signs long-term leases. So we've signed long-term leases that are, many of them are 2 and 3 years. And so there may have been a year where we held rent constant because they signed a long-term lease or a 3-year lease. So it might not just be year over year rents that we're talking about. So there might be an opportunity to increase rents. The same might also be. Just because rents are basically flat in Jacksonville right now, that doesn't mean that every rent is flat. Some are rising in some neighborhoods. Some are declining. That's how averages work. So it is possible for your specific situation for us to recommend and say, hey, you know what? I know it was rented for $1,500 last time, we're going to recommend 1450 right now. And for almost all of our owners who may have that situation, just think back to what the original rent was when you bought the property. I almost can guarantee you it was a lot lower than 1450.
Yeah.
So understand that no investment goes like this always, always, always. And rents can do the same thing. You can absolutely win if your rent is 1450 today. It was 1500 last year or 2 years ago, but you started buying the asset at 1200 for your rent. And that's a very similar situation for a lot of our owners.
Okay, sounds good. Mike Foster says, can you clarify again the average turn cost to owners? That is there an average amount that the departing resident gets back on the security deposit versus the average amount that the deposit gets retained by the property owner? You know what that granular?
You know, I don't know what the average percentage of the security deposit returned to the resident is. I don't have that data. I can write a note and maybe come back to you on that one. But ultimately, just rough math. If the rent is 1536, security deposit is equal to 1 month's rent for almost all of our residents. So just ballparking it, if the average cost to the owner is 1200, the majority of residents do have a portion of their security deposit withheld because they've lived in the home for 4 or 5 years and something broke. And so the majority is withheld. So I would estimate that the average cost for a property turn somewhere around maybe $2,500 feels about right.
Okay, makes sense. And then put another thing for you to write down. Chris Gonzaga, KOB, King of the Beach, asks, what's the average cost per owner yearly, including all costs? Is that a statistic that you have top of mind? Maybe we can add that to the next.
I'm not sure I understand the question. The cost to owner?
Average cost per owner yearly, including all costs. I would say if I'm thinking about that, and I think about that, it's like, what am I paying into my property yearly as an average by owning the property?
Are we talking about just maintenance costs?
I would say, yeah, I guess there's a couple of different ways to skin that thing, right? Maintenance costs, property management fees, but I guess it just comes out of rent, right? So
it was the KOB who asked that?
Yeah, the KOB.
Yeah, KOB, let me know specifically what you're thinking about. I'm going to write down average maintenance cost. And if it's more than that, then I'll aim to please, my friend.
Sounds good. Yeah, he says yes.
Okay.
So average maintenance cost. Good stuff, Chris. Okay. I appreciate it. That's a good one. All right, GC. So rent data looks solid, right? Like we said, it's been pretty flat recently. Everything else performance-wise looking really, really good. That means that cash flows, to me, I look at this and I think cash flows are stable, right? So
and growing. Because rents over time have grown significantly. Even though they're roughly flat right now, we're looking at year over year. Rents have been going up and up and up. And you know what hasn't been going up and up for our owners is their costs, meaning their debt costs, because you're in fixed rate loans. And so the majority of your costs stay stable. And over time, rents go up and up and up. So this is, again, playing out like we expect. The model is playing out exactly like we need it to ensure that we hit your financial outcomes.
And speaking of what we expect, the normalization, this is a graph that we come to often, right? The Jacksonville median home price over time. We see here the Great Recession and the bubble being illustrated, and this like run up that we've had post COVID. And this is another very visual representation of normalization. This kind of like flat up and down pricing points that kind of like stay in the same place. And now we find ourselves for the first time in a while, kind of consistently underneath this trend line of 4.8% appreciation down here for January, you know, for like this part of the market cycle. What does this mean, GC?
Well, so this is normalization played out like you were mentioning. And specifically what I mean by normalization is the actual median home sales prices should hug that trend line. And so they're going to be slightly above and slightly below. Now, we've seen some unique things in the last 25 years. And there have been some very large times when we went way above the trend line and then equally went way below the trend line. That's not normal. That was the Great Recession. So what is more normal is what has been happening, especially for the last few years, 2 years, 3 years, just we predicted. You're going to see us continue to hug that trend line. And what that means is when you are Above the trend line, you would expect to see lower than normal home price appreciation until you cross the trend line. And then you go a little bit below the trend line, and then guess what happens? You start to see higher than normal home price appreciation to catch up with the trend line. And we just are starting to see that higher than normal home price appreciation, or approaching normal home price appreciation here year over year. But over the next market cycle, that's what we would expect to see, is higher than normal home price appreciation if we're going to catch up with that trend line.
Got it. As I see this visually, I know that you and I have been talking about that you like comparing this thing to 2019, and we're going to get into this. But it really does, kind of like look like, if you look here in 2019, kind of like position it is in relation to the trend line, feels very visually similar, GC.
Yeah. And so I started, as I was going through the numbers here and I was trying to use this as a teaching opportunity, I was like, you know what? There's a lot of noise out there in the system right now about home sales and interest rates and whatnot. But if we cut away the noise, what's another time that we looked at? We said, you know what? That you and I hear on the show all the time. Oh, I wish I could go back to X date and buy more. I wish I could do this, right? 2019 comes up often, and that's because that's before the world changed. That's before COVID. And it's also because there was a lot of home price appreciation after that. So I said, you know what? Let's go back to May 2019, compare it to May 2026, and let's just cut the noise away and look at some of these metrics. So this was a fun little trip down memory lane for me, and I wanted to share it with all of you. But if we cut the noise away and we look at May 2026 and we compare it to May of 2019, you'll see a lot of similarities here. So, Pops, you want to read these for me? I got the camera in the way.
Yeah, I got you, man. So May 2019 had year-over-year home price appreciation of 3.7%. 2026, we just went over 3.9%. The trailing year-over-year 6-month, May 2019, had 2.6% home price appreciation. May 2026 has a trailing of 1.1%. Median days on market, May 2019 were 39. Median days on market, May 2026, 34. Months of inventory, May 2019, 2.7. Months of inventory, 2026, 4.0. Foreclosure rates, May 2019, 4.9%. and 2026, 0.9%.
How many articles were written in May of 2019 about this impending foreclosure crisis? I couldn't find any.
Yeah, I don't know.
4.9% is half of what a normal foreclosure market is. So just, again, real data here to show you that some of the wild claims about foreclosures are just off the rails. But look at everything else there. I mean, it is really similar. We're lower for days on market than we were in May of 2019. Months of inventory, we're still below 6, or right. I mean, it was 3 and now we're 4. And you can see the appreciation numbers are very similar. So just encourage you, stick to the facts, cut all the noise away, and this model just works. There is nothing to be concerned about with this model working. And it just works. We just have to cut the noise away.
It's really interesting because we've talked about it conceptually a lot, how you're comparing things to like 2019, 2018, and to kind of like look at just like visually here on just median sales prices versus trend line, and then visually here on all these other data points and how like strikingly similar they are. Some are a little higher, some are a little bit lower, but overall it looks very, very similar. And to think that this feels like normal, right? Like I would assume that 2019, we weren't doing this show. Like we were talking about doing the show at the end of 2019.
Right.
But I would assume that everything's business as normal back in 2018, 2019, 2017 for JWB.
Oh yeah, absolutely. It was. I mean, and it was a message of normalization and invest in this thing because it works in the long run. And a lot of the same things that I say really every week, and I'm saying here today, are the same things we've been espousing for 10 years, 20 years.
Got it. So we're going to compare kind of like your takes from the last couple of shows to this one, and go back into these numbers. But for now, a couple of the headlines that have been really standing out. The biggest one was this 21st Century Road to Housing Act. You want to kind of just give us a preview of like catch us up to a timeline on this thing.
So President Trump made headlines in January of this year when he said that he wanted to ban institutional ownership of homes. And that started this process, which has ended with legislation that's called the 21st Century Road to Housing Act. Now, the institutional ban has gotten all of the headlines. There's a lot of other stuff that has become a part of the legislation. And we talked about this last quarter. It was important to talk about then because I wanted to bring you up to speed. So we'll do a little bit of that here.
Yeah.
But there was one really important part of the legislation that I took a really big stand with you guys and said, we got to change this, which, you know, for anything political for me, it takes a lot to say that. I try to keep it apolitical here. But this was something that was really going to hurt affordability. And so I have a good update for you on that.
Cool. Goal of the legislation, noble, right? We want to be able to keep housing affordable enough for working class Americans, multiple kind of like paths towards this thing of increasing the housing supply, reducing red tape, talking about how like control institutional investors from like affecting the market, modernizing housing programs, increasing oversight and accountability. At the end of the day, all these things, pretty good ideas, especially increasing housing supply is kind of like the base thing of this thing. But the thing that you took this like stance around was this ban on institutional investors, you see.
Well, to me, it's getting the biggest headlines when it comes to this thing, and it has the least impact.
Yeah.
I want affordability for all. The way that you do that is you solve the supply side of this. So you build more homes, you cut the red tape, you increase density. But this is getting all the headlines. So I wanted to point it out that just how little impact it's going to have. Just for everybody's knowledge, institutional investors currently own less than 1% of all U.S. homes. You can see that here in the numbers. So if you are putting a ban together to solve a big problem, this isn't the problem solved because there's less than 1% of all U.S. homes that are owned by investors. And if you look at it today, investors are actually selling more than they are buying. They are net sellers, which means that they're actually creating inventory on the market. So if there was a time to do this, it would have been many years ago. The time now makes people feel good, I guess, to stick it to the man, which I certainly get. But at the end of the day, we need to be focusing on other things if we want to accomplish our goal, which is affordability.
Yeah. So number wise, not very significant of their effect on the market. And what they were trying to pass was this idea of like making them sell in under 7 years if you're bringing forth these markets.
Yeah, this is the big thing. So everybody, I think, was looking forward to this bill and legislation coming because it had the potential to really increase affordability largely on the supply side. And for me, my personal opinion was like, the narrative on the institution is what it is. It's fine. It's not really going to have an impact. So I don't really care one way or another. Yeah. But that was before this 7-year rule was instituted. So the House got a chance to put their legislation together in February. Didn't include this 7-year rule, which I'll explain in just a second. And then out of nowhere in March, the Senate passed their version of the legislation, and it included the 7-year rule. This became a big issue for everybody. Yeah. And what happened was the Senate put in this rule that institutional investors must sell their single-family homes within 7 years and only to individual homeowners. Now, what's actually happening, institutions are actually helping with the supply side. It's called build to rent. Institutions, JWB, would be categorized as an institution because we own more than 350 homes. We build 300 to 400 homes a year. So we're bringing 300 to 400 homes to the marketplace.
To an undersupplied market.
We're helping with affordability. And there are many other institutional investors that are doing the same. So we can ban institutions from buying, but let's not ban them from building and creating more supply. Well, when you tell an institution that they have to sell that home in 7 years, it breaks the business model. Yeah. And so by doing this, what happened was the debt and the equity and all of the financials behind build to rent said, you know what? I'm not going to play in that game anymore. And so the demand for build to rent and the money behind it evaporated once the Senate came out and did this. And so from that point forward, industry experts, lobbyists, and many who want affordability said, you know what, we're creating a problem here through this 7-year disposition rule that it doesn't need to be that way. We can still ban institutions from buying, but when they're adding supply, let's not get in the way of that. And so, yes, here's John Burns, who's a wonderful consultant that we work with.
Yeah, they got some good advice, right? Like the experts were basically saying, not a good idea. House went back, fixed this bill.
There we go. So that's the big update here, that the House did fix this with their version. And they removed the 7-year disposition rule. They created exceptions, which were previously there, which allow institutions, JWB being one of them, because we do own over 350 homes, to do build to rent or to build our own new construction homes and to renovate to rent. And there is no 7-year disposition rule in the House's legislation. Now, the Senate and the House have to come together and do reconciliation and make sure that they have one uniform bill. So we're waiting on that, but we're very hopeful that, and it's looking like that 7-year disposition rule will be eliminated, which will get us back to, I think, what we all want here, or legislation that creates more affordability and really helps the problem, not hurting the problem.
Got it. So sounds like there was I wouldn't say we dodged a bullet there, but there was a bullet coming and the bullet just got kind of deflected a little bit. We're going to see what ends up happening, but it is one of the rare instances that I see you kind of like give like very clear advice on what's good and what's bad and what's actually going to like help the overall state of the housing market. And it sounds like this 70 rule is unequivocally bad in your eyes. So be informed about this thing. If this thing passes, yeah, that's not in anybody's best interest, not real estate investors, not renters, not resident, not, like homeowners, stuff like that.
Yep. It's going to harm it. And luckily, I don't think it's going to be a part of the legislation.
Yeah.
It's not the way. But if it had passed, it would have done more harm than good, in our opinion. And you're right. Anything in the political sphere, I try to present both sides. So if you see me take a stand and say, "Hey, we got to do something about this," that means it's pretty clear in our eyes that it was something that was a harmful part of the bill.
Yeah, and if you're in a dinner party, the reason why is institutional investors make up less than 1% of all they sell less than 1% of the homes. So it's not really going to like help. And yet they build a lot of the supply.
Yes.
That's desperately needed. Very simple to understand. GC, speaking of other political kind of things happening, the other big headline out there is this idea of property taxes in Florida being eliminated. It's been quite a ride, right? Like it's been from a, hey, this feels like a circus stunt, to like, hey, this looks like it's gaining some steam, to now it's something we're really, really talking about. You catch up.
It's caught us by surprise as far as how quickly this has gone from an idea presented by the governor on some videos and social media and things, to now it is going to be on the ballot just 16 months from when the story started to take shape. That's incredibly fast, and it does have large, wide-ranging effects for us here in Duval County and Jacksonville, across the state of Florida, and I think across the country as well. This is, the governor is very strong in proposing that we reduce and potentially effectively eliminate property taxes for primary homeowners, homesteaded homeowners here. And there's pros and cons, which we'll go through in a couple of minutes here. But ultimately, today, homeowners have up to a $50,000 homestead exemption on their primary residence. And the legislation that will be on the ballot will increase that homestead exemption to $150,000 in 2027, again to $250,000 in 2028, with a future goal towards effectively eliminating property taxes. This would make Florida the only state in the country which has no state income tax and eventually would have no property taxes as well. So you could see that would be a claim that governor would like to be able to make to increase population growth in the state of Florida.
Sure. So it sounds like there is plenty of argument between supporters and detractors of this thing. Sounds like there's a lot of truth on both sides, right, GC? Supporters talking about more affordable housing, more money for homeowners, higher home values, like you said, making Florida more attractive, making government more efficient. Lower property taxes at the end of the day is a really good marketing for the state of Florida, which would attract people here and drive population growth.
Yes, and if we just think about this with our rental property investor hat on, if we had no property taxes, and again, we need to think beyond just rental property investors when you're voting, but if we only looked at it from that lens of being a rental property investor, this would dramatically increase our return on investment. Because what would happen is you would have even higher population growth, that would be even higher demand for housing, we are already undersupplied for housing. And so ultimately, if you have low supply and higher demand, that would increase prices. So this would not eliminate our property taxes as rental property owners. This is just for primary homeowners, but our values of our assets are based on what is selling in our neighborhoods. And so instantly, another home that's owned by a primary homeowner would be able to have a higher price because you could have the same payments because you no longer had property taxes, but the price would be higher, and ultimately it would increase home values for everybody here. So if we're just thinking about the best return on an investment as a rental property owner, through that lens, this would be good. However, there are equal and opposite, and potentially the way that you think about it, potentially more downsides to doing it, which is important to think about.
Yeah. So, back to this slide, as a rental property investor, this doesn't mean I'm not paying taxes, but it would mean population growth, more demand for homes in my state, which drives up home price appreciation for me if we're looking at it from a rental property investor standpoint. Downside here, as far as what the critics say of this act, is less public safety funding, less infrastructure funding. Revenue must be replaced in some way. So someone's going to pay for this, and we're still not super clear on what that looks like. Fewer discretionary investments such as downtown revitalization, economic development, community projects that we talk a lot about here. And at the end of the day, the unintended consequences. This is a unproven method of doing something. So we don't know what the externalities are going to be. So the critics ultimately say property tax reductions could reduce fundings for services and investments that communities rely on, and we don't really know how that ends up affecting long-term payments.
Yes. Ultimately here, nobody really knows the numbers on the thing. There is a lack of information when it comes to the numbers, and I think that is pretty scary. I think ultimately we all want more affordability. If there's a way to do it and reduce our property taxes, I think everybody would be in favor for it. But the things that we're potentially giving up are very, very important. Public safety infrastructure, those things, it's not just Duval County that depends on that. Think about smaller counties out there that really don't have as much of a revenue base other than property taxes. So and nobody just knows how the numbers are going to shake out. So I'm excited to learn more about the numbers. Our mayor, Donna Deegan, held a press conference about this recently, and they estimated that the budget for Jacksonville for Duval County would be decreased by about $300 million if this act was in place. She obviously is not for this. And she talked about some of the discretionary investments that we would not be able to make as a city and as a county if this goes forward. She specifically talked about things like downtown revitalization, economic development, and some of the community parks and projects that are very, very critical. So again, now if I'm putting on my hat as a JWB owner of rental properties, and we think about all of the momentum that we have for downtown Jacksonville, and we understand that when downtowns become revitalized, what does that do for your home values and for rents and median incomes and quality of life for everybody here? I could create another argument in my own head and say, you know what? Maybe that's not good as well. And so I really would just encourage all of you to, if you're in the state of Florida and you'll be voting on this, become informed. I think, the vote is in November. It's June right now. You have 5 months. I hope these numbers come out and that you can make an informed decision, but this isn't a simple one. And I do think that this is going to be a very, very close vote. The legislation needs 60% in order to take effect, 6% to vote for it. And so I would really, really encourage you to be an educated voter on this in the state of Florida, because I do think it's going to be a very, very big and important topic.
Yeah, makes a lot of sense how cutting property taxes could be one kind of economic boom, but then again, downtown revitalization and public project investments have also shown to be another kind of economic boon. So it's like, get really, really informed of what is the thing that really drives long-term prosperity and these kinds of things. It's not super clear based on what's happening. And I think everybody has their own things. And of course, each different municipality is different, right? Like a big city like Jacksonville that has things, gets access to it one way. Smaller cities, may not have the way to do it. Is what's good for the state good for the city? Is what's good for the city good for the state? It's really, really like unclear of kind of like both sides of this thing that we'll see We'll see where it shakes out, man. This is a really, really interesting headline.
I agree.
Unprecedented times, my friend. That being said, these have been your past predictions, GC. We like to hold you accountable here. You've been talking about how interest rates are going to roughly stay around 6.25, like 6.2%. 2026, it's at 6.3%. Home price appreciation, you said slightly positive, up a max of 3%. And right now we are a year over year, 6 months trailing of 1.1%. Months of inventory, you said that stay within the 4 to 6 months range. We're at 4.3 months. Rent price appreciation, you said slightly positive, max of 3%. Right now we are slightly negative, but it's been essentially flat. How do you feel about your predictions here?
I feel pretty good. I mean, predictions are, when you're making predictions about an asset class that is really consistent, it's a little bit easier to be right.
Yeah. Yeah.
We have seen some wild things that have happened in the first 6 months.
Yeah.
And we're 2.4 and we're 0.1% away from the third one.
Yeah.
This just goes to show that you're investing in something that is consistent.
Yeah.
That you don't have to be an expert in, and you don't have to understand all the ramifications that's going on in the entire world for you to invest in something that just works. And that's the type of thing I like to build my retirement on. I want to do it for you as well. And so when it comes to predictions, I feel pretty good about our predictions early on. Absent of some wild and crazy event, I think we'll be pretty close. Might not hit them all, but probably 3 out of 4. I'd say we'll be pretty good.
I mean, I think it'd be pretty fair to say that interest rates might be different if we weren't in a global oil crisis right now.
Right, exactly. I feel pretty good.
And inflation didn't tick up there. I kind of look at this stuff. I'm like, man, this is pretty impressive. I give credit to, I would say, like, one part you being a super smart guy, one part you being definitely a real estate expert, probably about 3 parts the fact that, like you say, real estate gives you the answers to the test ahead of time. This is an extremely stable asset. We've seen all sorts of haymakers being thrown at real estate in the 5 years that you and I have been doing this show, and it just continues to chug along with a surprisingly high floor and delightfully high upside when you do it right. So we're gonna give key takeaways, but before and hit some Q&A right here. But before we do that, GC, on Thursday, I'm gonna be hosting this JWB Featured Properties webinar. This is essentially, if you like this information, you like being in an asset class that is predictable, that is boring, that you can really count on for retirement and having all these options at the end of the day. What does the purchasing decision look like? We're going to talk about that. This report here is for everybody to get informed. Thursday is going to talk about you to be like tactically tactically enabled.
There we go.
To make a decision of, do you want to grow your portfolio right now? We're going to go through available actual Jacksonville properties, expected returns and performance, property details and rent info, and why these certain properties stand out. So we'd love to have you there. I'd love to have you there because this is something new that I'm going to be doing without GC. I'm going to be doing with Kate, who is one of the founders of the show.
Yes,
right?
She is.
She's been on the show before, and we're just really going to go through purchasing decisions. As you all know, I am a rental property investor myself. I'm looking at expanding my portfolio myself. I've got some pointed questions of new construction, renovated construction. What are interest rates doing? Should I cash out, refi? These kinds of things. I'm going to go through it from the investor standpoint in a purchasing decision. So click on the link in the chat that Joanna is sharing right now if you want to register for that. Would love to have you there. Would love to have the community there, just asking the questions that you always ask, like being really smart, being really like special to everybody that joins. And if you're new, this is a really good, no pressure opportunity to kind of like kick the tires if you want to kick some tires without being on a sales call and just kind of seeing me go through it. So would love to have you there on Thursday, June 18th at 3:30 p.m. Eastern. Send an email to marketing@jwbcompanies.com if you want to find out anything. Do you see you got anything?
Yeah, let me just make sure, just because you're registered in here right now, that doesn't necessarily mean that you're registered for the Featured Properties webinar.
Correct.
So if you're not sure if you are or not, go ahead and click the link in the chat, or just send an email to marketing@JWB Companies. But if you're not sure, just go ahead and register. Again, there's no harm in doing that, but did want to make sure you know that, and it will be a different link than the link that you clicked on to get here.
Correct.
So all of our regulars, you have the same link every single show on Tuesdays. This will be a different one. So again, if you're not sure, click the link in the chat, register. or email marketing@JWB companies and look for that separate link for you to be there on Thursday.
Again, would love to have you there. This is going to be a new thing for me in the studio with Kate. It's going to be a lot of fun. I think it's going to be a concept that we continue to do. I think this adds value to the purchasing decision. Shows kind of like edutainment, right? Like we're educating, we're not being very salesy. I think there's people that come here and sometimes they have these very pointed questions that we don't always have time to get into it. We'll have time to get into those questions on that webinar. So GC, number one takeaway of what the Jacksonville market is doing. Talk to me.
Jacksonville's real estate market continues to normalize. It's the same message I gave last quarter. It's the same message this quarter. Guess what? It's likely it will be the same message next quarter. But the thing that I want you all to know is that all we have to do to succeed in this asset class is be normal. And most of the time, that's what this asset class does. So normalization is where we are. It's what I expect to continue. And then if we cut through the noise and we look other times that we knew were great times to be able to buy rental properties like May 2019, and you compare that with the objective facts today, you're going to find a lot of similarities. So hopefully that helps you and informs you as you are thinking about making your decisions to buy more.
In a crazy world, a normalized experience seems like a very attractive thing.
Yeah.
And that is the bubble that we live in as Jacksonville real estate investors right now. So again, don't let the noise of crazy world fool you. Right now in Jacksonville, more like 2019 when it was just normal times. Nobody was freaking out about rental properties one way or another. And that means that those of us that just want a good experience under the radar it's a good time to buy. Takeaway number two, new housing affordability act. Talk to me, GC.
So the narrative of the bill is all about the institutional ownership and banning that. That is likely to pass, meaning that is likely to be a part of the legislation. Just know that that actually has very little impact on institutional ownership and affordability. There are a lot of other good things in that bill that can do some really great things for affordability, but it is critical that the exemptions to that legislation include being able to do build to rent, being able to do new construction, being able to renovate, and eliminating that 7-year disposal rule. We feel pretty good about that legislation moving forward without that, but just keep it on your radar. And if it sneaks back in, we need to get very loud about that being removed because that's going to cause more harm than good.
Yeah. Affordability bill intention good. That one provision, the 7-year disposal rule that's meant to choke out institutional investors. If you're at a dinner party, institutional investors do not make up a significant part of the market, so it's not actually going to help. And they actually build a lot of homes, and we have a deep supply need. That's really the long-term effect. Takeaway number 3, GC.
Yeah, this property tax debate is hotly contested. I would encourage you to be an educated voter if you're in the state of Florida. It can be it both ways. Lower property taxes could boost affordability and housing demand and real estate values, and your return on investment as a rental property investor could also do the opposite because we don't know how the numbers are going to shake out, and the benefits could be outweighed by the costs and the loss of local government revenue, potential decrease of city services, and specifically community investments. Things like downtown revitalization efforts and incentive programs and the parks and projects that we have been investing in. Those things are on the table. So get educated and vote. And we're going to see how this thing shakes out. It is a monumental vote.
Important vote, understand the nuance. We're not going to tell you exactly what to do here on this show. This one is a little too political for us to get involved, but really, really get informed if you're in Florida. And make sure that you get your opinion out there, GC. Speaking of tax-free stuff.
How about that, huh?
Tell me about this little thing you got going on, buddy.
Yeah, so this is really an opportunity for anybody who is local or somewhat local, or if you want to fly in. But we're going to be hosting our Jacksonville tax-free real estate investing tour. It's going to be on July 24th, free to attend, and space is limited to 50 people who would like to attend. We're partnering with Inspira Financial, which is a self-directed custodian, allows you to take your retirement accounts and invest in real estate. So we're going to have an expert from the Inspira team. I will be there. I'll be sharing the story about JWB investments, rental properties, and how it relates to the downtown revitalization. So think about it. For anybody who was on the summit, it's similar to that type of an experience, but you're going to get that downtown walking tour, and it'll be here on July 24th, so you don't have to wait another year if you missed out. So would love for you to attend. Again, July 24th, The link is in the chat. Joanna has put that in the chat. Thank you, Joanna. Appreciate that. If it is something you'd like to attend, go ahead, click the link in the chat, register, or you can just send an email to marketing@jwbcompanies.com.
Friday, July 24th, downtown Jacksonville tours, not to be missed with everything that's going on there. Plus, Inspire Financial, great partner of the Not Your Average Investor community. I'm a client. I think you're a client of Inspire Financial as well, right? So find out about tax-free investing in your retirement account. Last but not least, if you want to talk to the JWB team, call JWB 904-677-6777. Text us at 904-293-0341, or go to chatwithjwb.com. Hop in, look at the calendar, set up a meeting. GC, you got some time to handle a couple of questions here?
We got to say thank you to everybody for being here. If you do have to go, I know we're a little bit over. Thank you for being here. This is super fun to be able to share all of these insights with you, and you guys make it possible. And yeah, let's hang around and answer some questions for those who can stick around.
Okay. MJ Barreto, he's asking, I believe when looking at JWB properties, you are quoting a 4.8% home price appreciation. How do you calculate that and square that against this data, right? We were talking about 3.9% home price appreciation. I'm looking to put 30% down, get zero cash flow, and all my eggs are in that appreciation basket right now.
Okay. Let's take a couple of things. Answer the question first, and then let's talk about the last comment there.
Yeah, there in front of
okay, perfect. All of your eggs are in one basket here. So how do we get the data? Well, we go back and we look at what has been the average appreciation rate for the last 40 plus years for the market here in Jacksonville. And you can do this in any market out there. But you go and you look over as long of a time period as you can, because you want to see what the average home price appreciation rate has been. That's your expected home price appreciation rate over the next market cycle. If you have 40-something years of data, you've got a couple of market cycles there. Well, it's very likely that if you look over the next market cycle, 10 to 20 years of ownership, your home price appreciation on average is going to be there as well. And so that's what we do. That thesis is what guides our investment thesis overall. And that's what's helped to create over $300 million in profits for all of our clients over the last 20 years. So that's what you're plugging into. It is data-based and it is objective. And every year we get the new home price appreciation rate, and then we just use that and we adjust what the average appreciation rate is per year in Jacksonville. So that's how we do that. The one thing I just wanted to add, you had mentioned you're putting all of your eggs in one basket.
Before you go there, GC, I would just say to MJ, we kind of talked about it on the show, and it was probably before he answered, or like after he asked this question. I just want to point out the idea that, like, MJ, you're looking at making your first investment, right? Like, I would recommend that you are looking at this as a 10, 20-year decision, not a 3, 5, 6-year decision. And because of that's like, for me, I look at this as, you know, that time horizon, it's funding my retirement. It's those kinds of things. So when I look at it as an investor, and I'm actually in a purchase cycle right now as well, I'm thinking, you know, it might be 3.9% appreciation this year over year, but I know that over the length of time that I want to hold this property, it's going to be at that 4.8% appreciation, because all this stuff kind of like repeats and cycles, right? So this is just short-term numbers. Short-term numbers are what drives headlines, you know, like what people really, really want to talk about and what we can talk about year to year. It's not a lot of fun to just say, hey, guess what? The average is still 4.8% to do one of these shows, right? So like, the difference between what's on the performa is based on the criteria of purchasing this thing, holding it for a full market cycle, which is what I'm pretty sure JWB is telling you should be thinking, because that's what they were telling me as well. Whereas the number from today is just like, this is the year over year thing in a snapshot.
And it's a really great point, because 3 years ago, 4 years ago, 5 years ago, we saw 10% home price appreciation, 15% year over year.
And that's what we're talking about on the show.
Yeah, exactly. Right.
Yeah.
And what number did we put on our evaluations? 4.8% home price appreciation. So everything we do is about the long haul and the long term, because that's the goal we're trying to accomplish for MJ.
Yeah. Let's talk about the eggs in the basket. I know you got a good point there.
And the reason that you're investing here is because you're going to win from 5 profit centers. And those are net rental income, tax savings, principal pay down, home price appreciation, and inflation hedging and inflation profiting. So while you may look day one and say this thing's going to be break even or slightly cash flow positive, and that is true, that's not the full picture. You're not putting all of your eggs in one basket for home price appreciation. Home price appreciation is the largest component of your gains, But don't forget about tax savings. Don't forget about principal pay down. And your net rental income goes up and up and up as you own. So the cash flow is there when you need it. It doesn't change your life day one, but it's there when you need it. So that's really the big picture that you're investing in, MJ.
Yeah, and MJ, I would say you're putting somewhere between 60% of your eggs in the home price appreciation basket, right? Like when we look at these, I recognize your name. I know you've been here for the last couple of weeks at least. I don't know if you've seen one of our real investor breakdowns, right? We always break down when we have a guest on the show that's invested, myself included, Leslie Wilson included. We break down profitability per profit center on a pie chart. And when you look at it, you consistently see that home price appreciation makes up 60 to 75% of the overall return. And because of that, we call it a Pac-Man, right? Like it looks like a Pac-Man on a pie chart. Everything else is the mouth, right? So what you'll see is that home price appreciation will be a majority of your returns, but over time, your cash flow goes up. That's going to happen, right? So you are putting a lot of eggs into home price appreciation because that's the name of the game in real estate. Cash flow gets you there, and cash flow, like a fine wine, gets better over time as well, right?
There you go.
Okay.
Thank you so much for the question, MJ. All of your questions have been awesome, man. So I'm really excited for you.
My boy LinkedIn Lowry is asking, GC, I saw reporting LinkedIn Lowry is a local, right? So he pays to the local news as well. I saw reporting that the proposed property tax amendments impact to the Jacksonville budget may cause grocery chain Publix to rethink whether they would build in Pearl Street because the city won't be able to offer incentives. Any insight or thoughts, or too early to tell?
I haven't heard that at all. I think I would have heard that.
Yeah. Okay, got it. But it's in line with what you're talking about, right? Like if this property taxes go away, these incentives that are attractive to developers and are attractive to people, it's going to kind of like change the calculus going forward if this thing gets passed. So it's something to think about.
It is something to think about. There is a growing narrative about the amount of incentive dollars that have been given to developers downtown. And you know, there have been a lot of incentive dollars that have been given. And so there's that narrative out there. The dollar for incentive dollars are going to be harder to come by in the future. And that's what we want. We want to create a scenario where you do need to start this flywheel with incentives, but then downtown is operating just like Nashville and Austin and Tampa without the need of incentives. And so that's where we want to go. But the noise is real. People do not like giving incentives to developers, and I get it. And then if you throw on the property tax issue of the reduction of property taxes, then that's going to make that noise and that challenge even greater. So I do think it's something to pay attention to. Specifically, I haven't heard anything about this affecting the Publix deal, which is in Pearl Square. That's all I was saying on that one.
Real quick, Jeff Bonser, I just mentioned this idea of a full market cycle. Jeff Bonser says, full market cycle. What is a full market cycle?
Yeah, so a full market cycle is known to be between 10 to 20 years. And the reason that it's 10 to 20 years, because if you look over time, it usually takes somewhere around 10 to 20 years for that full cycle to play out, meaning that home price appreciation averages back out with that long-term growth trend is. So that's really why the thesis of investing in a JWB rental property, or really any single family rental property, is hold on for a full market cycle so that you can count on home price appreciation, because it's very likely that will be in that range for your next 10 to 20 years.
And I would say, Jeff, welcome to the show. I think this is the first time we read your name, so glad to hear. Make yourself comfortable. Something that we talk about when it comes to full market cycles, I think we're so used to like cycles being like positive and negative, right? In real estate, you know, that's like that in other asset classes. In real estate, the market cycle is really more like faster growth and slower growth.
You know what? I want to put that visually out there.
We should put that visually.
I'm going to write this down for a future topic.
Yeah. So it's not like you're not looking to like buy the dip in real estate, right? It's just kind of like what point you're getting in where it's either moving faster or slower. But we've really only seen a dip one time in anybody's lifetime.
The only times we have seen home values decline in Jacksonville were during the Great Recession.
Yeah, exactly.
So 90% of years home values have gone up. That's not what we typically think of cycle.
Yeah.
It's like a cycle that
It's more,
as
yeah.
goes as low as like flat.
Yeah.
So
Yeah.
anyways, we'll come up with a better visual to help teach that in the future.
Love that. Diane Jacques asks, what's the average percent increase in property insurance and property taxes annually? Where are you at that, GC?
So I don't have a figure for you, but what I do know is that the increase of insurance costs in the state of Florida are the lowest for any state across the country from last year to this year. It's the lowest of any state across the country. So what that is showing you is that the Florida insurance market has stabilized. We have more insurers coming into the state, and there's actually talks of insurance costs potentially going down, although I don't want to get everybody's hopes up too much on that. But what I can share with you is that stabilization in insurance is a really, really good thing, and you do not have to be worried about these incredibly high increases to property insurance costs like we had a few years ago in the state of Florida. That has come and gone, and it's much more stable now.
Awesome. I just read this in the chat, but MJ is saying, thanks, gentlemen. I'm trying to maintain a personal 19-year horizon of investing, looking for the first, maybe second as well. You and me both, brother. I'm also kind of like in the same kind of like horizon. That's cool, MJ. Really, really interesting. MVP Lee says, does JWB have to sell 50 homes to become compliant with new rule?
No, I'm glad you asked that. There is no requirement for a company to sell a certain number of homes to become compliant. It's not like a company that has 10,000 homes has to sell, 9,700 homes or whatever to become compliant. That is not required. So that's important. If there were 4 sell-offs, then that'd
be totally different.
That could be totally different. That's not discussed at all.
Yeah. So again, I think, well, maybe Lee is saying, in order to avoid that 7-year rule thing, you might be able to sell 50 homes and be under that piece.
Sure. Yes.
But not something, I think you and I have talked about this, and it's just not something that's like feasible for you guys, right?
Well, I'm operating from the place that I don't believe legislation is going to pass that includes that 7-year disposition rule. Yeah. If that was the case, then we would have alternative solutions at JWB for us to continue our business model. And I'm sure we would solve it, but I'm not even wasting any time or energy on that because it's just looking like smarter head prevailed here and removed that disposition rule.
Mike Foster is asking, is the governor still saying he would not make up lost property taxes on the shoulders of rental property owners?
He actually is not planning on doing that. They have come out and said that is not the plan to do that, and it's also not on. There was something, I can't remember the percentage, but there was something specifically about not putting it on business owners as well. So they're very, very specific about not putting it on additional property taxes for rental properties or rental property owners, and also there is a limit to the amount of taxable increase on businesses as well to try to prevent some of those actions.
Interesting times. Mountain Man Billy Green asks, I'm past the 3-year refi penalty. I'm just going to move this over to my screen. Sorry.
Attaboy.
I'm past the 3-year refi penalty period for my properties. Is it strategic to try to refi, find a lower interest rate, and go with the same underwriter, or just shop it around right away? Also, I have roughly 50% LTV on all my properties. Should I speak with a JWB Pro to pull out just enough for a down payment on a new purchase with JWB?
Absolutely. We have some really, really cool tools to take that whole discussion that you're going through and to condense it and to give you actionable plans. And we have the tools to do it. I haven't seen them anywhere else. So really just Mountain Man, start with us. Get on the phone with your portfolio manager. We'll be here to support and really create this framework for you. And then specifically to your question, do you shop around or do you use a lender that you've used in the past? We're going to help you there too. In reality, you can use anybody to do a refinance. When you purchase a JWB home, you do need to use one of our approved lenders. And so our approved lenders can help with the purchase as well as the refinance. And almost in every state in the country as well, meaning if you live in any other state in the country, or if you own properties in any other state in the country, you can refinance properties in a different state and use that to further your JWB investment plan. So long story short, we got you covered. Just jump on the phone with us and we'll get the party started.
Sounds like it's worth a call, Mountain Man. Good stuff, JC. We went almost a half hour log,
Oh man.
which we didn't set out to do, but man, I love these market updates. I love how the community shows up in force for this thing. I love the questions. I hope that you, if you are trying to make sense of this, if this is a purchase for you, join us on Thursday for this inventory show and start going like really through these purchasing decisions. I promise to really put the lens of a purchaser. I'm in that life right now. I am a member of this community and also a real estate investor in JWB. But GC, any final words here?
Just thank you. Thank you guys for giving us this opportunity to do this. It's really a blessing to be able to do what you love and to share it with the people that you love. And that's really what this community is. So I love this quarterly routine that we're in. It just seems to be the right amount of time to bring you back into the loop. And your money's in a good hands and a good spot in the right asset class. We're going to keep working hard for you.
All right. I also want to point out, we went hard at these numbers early instead of these headlines early because it is what you asked for. So would love to hear any kind of like feedback on, do you like the deep dive into these numbers? Do you like the expansion of the rental numbers? This is all feedback that we've been getting from the community. We continue to do a show for you. This is not for us, it's for you. And you tell us about it based on feedback, based on you showing up every single day, taking an hour today, hour and a half out of the middle of your workday to come here, get educated, be part of the community, answer questions, ask questions, stuff like that. So it never goes unnoticed. Really appreciate you being here and all the good signals and feedback that give us. Keep bringing them. We're going to keep giving you what you want. And from now till then, GC, any advice? Don't be